Hey, Tooth and Coin family. Today's episode is going to be a little bit different than our last few episodes. I hope you've been enjoying the content lately. This one's going to be kind of an update of just a few random things that I think would be interesting to the people listening to this podcast. So we're going to be talking about three main things today. We're going to be talking about the BOI. We're going to be talking about some of the President Trump tax changes that could be on the way, as well as we're going to be talking about a tax savings scam that is being popularized by a lot of people right now, and one that you'll want to make sure that you avoid because the IRS knows about it and they're coming for you. Buckle up, it's going to be a fun episode, so here we go. First, we're going to talk about the BOI, the Beneficial Ownership Information Report that is being required to be submitted to FinCEN, the people who are supposed to keep us safe from all the scary people that own all these businesses here in the U.S. So if you're not familiar with it, it is something that came out that it was supposed to be a required filing. There's a lot of confusion about what it is, who's responsible for it, and things like that. Effectively, it said you've got to submit to the government, to FinCEN, that who is the owner of this entity and who benefits from the ownership of it. And you had to submit things like your social security number, your personal address, your copy of your driver's license to make sure that you're a real person. And you had to basically promise that it was actually you that owned this business and you were the one who benefited from it, as well as any partners and things like that. And then if anything changed, you also had to update that form periodically within like 30 or 60 days of whenever that change occurred going forward. This thing follows a $500 a day penalty for not complying with this requirement. So incredibly steep. It has nothing to do with income taxes. And obviously being a CPA, that's what we focus on. But every one of our clients are business owners, and so it obviously affected them as well. So we had to become somewhat familiar with it just because all of our clients were going to be subject to it, and they didn't really know who to talk to about it. So that became us. So long story short, we all thought, in my profession, thought that this was going to be kind of like the real IDs, where you had to go and get these driver's licenses, and they said, hey, you got to do this, got to do this, got to do this. And it would just get pushed back and back and back and be years before you actually had to do it. And surprisingly enough, that wasn't happening. It just didn't ever happen. So we actually sent an email out to all of our clients in November saying, hey, we think this thing's probably going to go through based on everything we see so far. And so you may as well just file it. It really just takes 5 minutes to do. It's not a big pain, but it's annoying to have to be filing something with the government when you don't feel like you should have to. No one wants to be forced to comply with something like that. Unfortunately, that's what the BOI is. And then on December 4th, maybe a week or two after we sent that email out, we did a video showing people how to file it, to do it on your own. We gave some alternative ways to be able to do it as well. And on December the 4th, an East Texas court came out and said, hey, guess what? This is actually unconstitutional. And there had been other courts that have said it wasn't constitutional, but they only apply to specific companies or specific states. The one East Texas said on a nationwide level, it's not constitutional. I believe it was a district court. And so, yeah, that meant that it is no longer required as long as that court's ruling was upheld. Not surprisingly, the Attorney General struck down the injunction and it's on appeal now. So now we're just waiting for finding out what's going to happen with BOI. But as of today, it's not required is the thing. It makes it really complex because of the fact that it's meant to be in action January 1st of 2025. And as of today, which is December the 13th of 2024, I'm not sure when this episode's going to go out, it currently is in limbo. So no one really knows if it's going to have to be done or not. My advice to my clients that are saying, like, hey, what should I do? Just go ahead and file it. It takes 5 minutes. It's not a big pain. If they end up making it be a requirement, you file it. You don't got to rush to get it done, but don't spend too much time thinking about it if you've not filed it yet and you're not worried about it. Just pay attention to the news. Hopefully you've got a really good CPA firm or attorney that's telling you how to do these things. And just word of caution on that. If your CPA hasn't spoken to you about this, it's not their fault. This isn't a CPA thing. This is just a report that has to be filed that has nothing to do with income taxes, nothing to do with CPA stuff. If anything, whatever attorney helped you set up your business is likely the person who probably should have told you about it. That's another thing that's really unclear. Like the AICPA, the governing body that takes care of the CPA industry, they've even said, hey, we don't think this is constitutional. CPA definitely shouldn't be the ones responsible for filing this. And the reason they do that, it's kind of like with the American Dental Association. They talk to insurance companies. The AICPA also talks to the malpractice insurance companies for CPA firms. And malpractice carriers are like, yeah, we ain't going to cover that if a CPA firm files it incorrectly, and then that client has penalties, and then there's malpractice. Like CPAs just won't be covered under malpractice if that's the case. So the AICPA is trying to fight it as much as they can because of that reason. So long story short, again, I've said that twice now, I think, but as of today, the BOI is no longer required as of 12/13/2024. If that changes before this episode comes out, then there may be an update depending on when you're listening to this. But hopefully it stays the same. I sure as heck hope that it goes away and doesn't come back, but we'll see. So the second thing we're going to talk about is we've got a president starting in 2025, which is fairly unique. I believe it's Grover Cleveland is the only other president who's ever had non-sequential presidencies other than President Trump. And yeah, there's a lot of things that could be changing down the pipeline in terms of tax stuff. So number one is in 2017, we had the Tax Cuts and Jobs Act, which was set to expire in 2025, 2026, assumably comfortably after Trump would have likely been out of office. Well, lo and behold, he's going to be back in office. So it's very likely that many of the big changes that happened in that time frame are going to be renewed or prolonged for even longer and not expire like they were going to before. So some of the things that are relevant to dentists that are out there, there's pass-through entity taxes, which are things that it's been a really good tax savings for the SALT caps that were implemented back then. So basically what it said was one of the things that this 2017 Tax Cuts and Jobs Act actually implemented was saying that you couldn't deduct state income taxes on your personal tax returns. But in a way, a lot of states said, hey, we're going to be sneaky about it and let people pay their taxes through their business. And it's going to be a way to get around this like cap. That thing was introduced in 2017. That's may not be extended because people know that people are doing it now. And to be honest with you, we don't want it to be extended because it's a lot of work for us as CPAs to help you guys file it. It's a whole bunch more paperwork. We got to keep up with another payment every year or multiple payments every year for it. And so that going away would be a good thing. And it's going to be a delta neutral like thing to the people that are already doing the PTE. So you'll just stop doing the PTE. You'll go back to doing it on your individual return. You'll pay the same amount in taxes, but you don't have to do all the extra steps that are associated with it. So that's a good thing. That thing could be going away. It may not. They may say, hey, no, that worked perfectly. And we're kind of playing inside baseball here. The reason that they put that SALT cap on there was because historically we used to have what was called AMT, the alternative minimum tax to income taxes. And the way people typically got into the bucket of paying AMT was through the state and local income taxes being really high on their itemized deductions. And it created this it's super complex. So just trust me in saying that if they do away with it, but they don't bring AMT back, it's a pretty good thing from a tax perspective for paying less in taxes. So that's good. He has talked about getting rid of income taxes totally and replacing it with a tariff system or maybe like some type of a VAT. And if you think that's a good idea, I'm not going to argue with you. I would love to not pay taxes anymore. Obviously, as my profession, an entire industry of CPAs would be looking for new jobs in some ways. We're looking to provide value in different ways also. But some candidates have been talking about getting rid of income taxes since like the 70s and 80s. Will it ever happen? I don't know, maybe. Are tariffs a good idea or a bad idea? Again, I'm not one to opine on international economic trade and the impacts on the U.S. I will say that a thing that's complicated is that the IRS and income taxes are one of the few ways we generate revenue on a nationwide level. So getting rid of it and replacing it with the tariff system is a little bit of a head scratcher, but maybe, who knows? We'll see. There's a person on YouTube that I like to watch. He does a really good job of mixing economic theory with real life experience as an investment banker and economist. His name's Patrick Boyle. So go look him up on YouTube. He's got a really good video that's titled, I believe, like, Can Trump's Tariffs Work? It's Patrick Boyle. So I do recommend going looking at, watch the video. It's like a 30-minute video. It's just about tariffs and the impact on the economy and the historical impact of tariffs and like what could happen from it and things like that. I'm really nerdy and I like that kind of stuff. So it's a good delivery. It's a good video to go watch if you're interested in that. So that's Patrick Boyle. The only other real experience I have with that is, and you, maybe if you're listening to this, you can hear it, but for a long time, people would make fun of me saying I sound like Ben Stein from Ferris Bueller's Day Off. There's going to be a lot of people, I just realized, that like are listening to this, probably haven't ever even seen that movie. And they're going to be like, I don't really know what that movie is. It's a movie from the 80s. I believe it's the 80s. It's a classic movie. It's a fantastic movie. And there's a person at the beginning that goes, Bueller, 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 Ben Stein. And one of the questions he asked the class is, the tariffs work after World War II to reinvigorate the economy? And the answer is no, they didn't. That's really my only experience in looking at tariffs and their impact on the economy is that quote from that movie. So if you haven't go seen Ferris Bueller's Day Off, it's a good one. So the third thing that we're going to talk about today is the IRS came out with a notice, IR 2024-304. That was actually on December 4th as well. Maybe I got my dates mixed up on the BOI. Maybe that was a different day than 12/4, but it was about that time frame, whatever. The notice is saying that charitable LLCs, that they're seeing a very big rise in scams associated with charitable LLCs. If you have listened to this podcast for a while now, leveraged donations is something that I tell people to be very careful of. And guess what? One of the main ones that they do this with is with charitable LLCs. The IRS came out and said, hey, we know people are doing this. Be ready because we're coming for you. The letter notes these promotions often target high-income filers and are considered abusive transactions by the IRS. Taxpayers should always remember that they are always responsible for the accuracy of information reported on their tax return. Participating in an abusive scheme to reduce their tax liability can result in assessment of the correct tax owed, penalties, interest, and potentially fines and imprisonment. Charities also need to be careful that they do not knowingly enable these schemes. Big warning shot fired over the bow from the IRS saying, hey guys, if you're going these routes, be careful because we know you're out here in those waters and we're going to come after you. So to give you the premise of what this is, what they're saying is they're kind of taking a play out of the syndicated conservation easement playbook of using these leveraged things. And effectively what happens is they say like a tax schemist rather than a strategist. I'll start using that term maybe. A tax schemist will tell you, hey, you can create this business over here. It's not a charity, it's a business. And you're going to contribute, I don't know, $100,000 to this LLC. So you create LLC, you fill the LLC up with $100,000. And then you and your charitable feelings and emotions, you've created this business that's this LLC and you've got a business plan. You got all these ideas and things that's going to make money on you. You started doing a few things here and there with it. Maybe file some paperwork or something like that. And you decide that, what I should do? This is such a good business that I'm actually going to donate this business to a charity. And so you donate like 60 to 80% of that LLC's ownership to some charitable organization. But before you do that, you get a valuation on that business. And someone says, oh man, this business is so valuable with this $100,000 in liquidity. It's got this great business plan. It's got this great idea for what it can do. This business is worth $600,000. If someone wants to buy it today, you can probably find somebody to tell you it's worth $600,000. And so what you do is you go and you donate 80% of your ownership to this charity that's worth $600,000. And you get what's 80% of $600,000? $480,000 if my quick mental math is working. So you get a $480,000 charitable donation for your $100,000 in contributions to this LLC that you donated to somebody else. And by the way, that 80%, it is a non-voting, non-working interest in that LLC so that you get this really big charitable write-off. And then you, since you're the only one who owns voting shares of this LLC, then payroll yourself for the management of said LLC for about, let's say $5,000 a year for, about 20 years. So you just funnel all that money out and give it back to yourself. This is a scam. This is not something that you want to do. This is not something that is aggressive. This is something that is fraudulent. And there are people that are out there that are selling these things every day. We talked to someone the other day that they were quoted $100,000 to have this be set up for them. There are people out there that are willing to take your money to pretend that they can save you money in taxes or to just ignore the tax code and not tell you about it. So it is your job to be aware of these tax codes. And so I'm out here fighting the good fight to make sure that you guys understand what these tax schemes are. So be very, 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 very careful of these things. If you want to give to charity, I'm all for it. I give a lot of charity. It's something that I believe very personally in. I think it's something that you should too as well. But I'm not saying to do this. Be very, very careful and wary with anyone that's coming out with that. The other thing that the IRS stated in this letter was something pretty telling. It says that they're paying attention to what all these tax schemists are trying to sell to people. It seems weird to think there's somebody at the IRS like hanging out on TikTok or on YouTube, looking up all these sales pay-per-click ads of how to save money. Maybe there's even people from the IRS that are going on to these sales calls with these people to find out more about what's going on with this. It's really interesting. I never thought I'd see this day that the IRS is doing that, but it's probably what's happening because this happened really fast. It seems like these things got really quick. About 18 months ago is when they first started kind of crossing our desk. And they're already issuing letters about it, which is really, really fast. So while the purpose of getting this out there is to say, hey, if you're being targeted by one of these promoters, be really, really careful. Just so you know, the IRS came out with some key points on it. And I'm betting these key points are probably things that they pulled straight from marketing material from these tax schemists to try and keep you from paying taxes. The things they said were, be wary of any promoter that's marketing a transaction as a way to grow wealth in a tax-free environment and claim charitable contribution deductions. For any promoters marketing a plan that requires the creation of one or more entities in order to make a charitable donation. For any promoter that is creating entities that do not engage in any business or activity to facilitate a charitable donation. They said to be wary of anyone saying to donate an interest in an LLC that loans cash or other assets back to the taxpayer or a related party. For the charity, as the majority owner of the LLC has no control over the LLC or its assets. To be wary of if the taxpayer is allowed to personally use the assets contributed to the LLC after the donation. That the promoter assists the taxpayer in the creation of intellectual property to fund the LLC prior to the donation. There's just a whole list of them. It's a really interesting thing because I'm betting that they pulled these things straight out of a sales pitch. Again, really interesting stuff that the IRS is coming out with. So the things that they said in this release is that they're working to increase compliance activity involving high income and high wealth taxpayers, as well as anything targeting, and this is a big one, complex partnerships and corporations, abusive schemes with invalid or unacceptable donations of LLC units, as well as other questionable transactions are on the agency's radar. And what's important to note about this is whenever you actually take a donation that's related to an LLC is you do have to file a special form for that. So they're going to be able to figure it out pretty quickly that these things are out there and target the people who are donating them. And they said that the IRS has multiple active abusive promoter investigations underway and continues to audit donations of closely held businesses. Then they give some list of examples of criminal convictions involving promoters of these schemes and their clients. And the first one they link is a Florida attorney sentenced to 8 years in prison in fraudulent charitable contribution tax scheme. Tax attorneys and an insurance agent convicted in tax shelter scheme. A client of fraudulent tax shelter scheme pleads guilty to obstruction of justice because they said the wrong thing in their core stuff. I don't want to pay taxes either, but I don't want to be involved in any of this. So I hope that people that come to this podcast have learned that for the things that I tell people to be wary of. And I hope that you've heard over the last few episodes when we've been talking about tax opportunities that I say leveraged charitable donations is always something to be scared of. It is. Anyway, today we talked about 3 things. We talked about the BOI. We talked about some of the big things happening with Trump. And we talked about some of the release in the IRS information that's coming up with this charitable contribution scheme that's going on. And there's other stuff on there. It's a really good read. If you want to find it, it's actually on the IRS's website. And it says IRS alert, charitable contribution scams on the rise. Taxpayers beware of those promoting fraudulent schemes. That's the title of the article. And it's worth a read if you let me read these things. So be very aware of it. Be safe out there. The tax saving streets are rough at night, and these schemers like to come out there and try to separate you from your money. But I hope you know that you can always trust Jonathan here at Tooth and Coin to give you the good information and the real information. So from all of us at Tooth and Coin, stay safe out there.